Will oil companies beat the climate changes? The Fink says yes. Is freedom 1 week away from New South Wales? But what about the rest of the country? And interest rates to rise with the RBA in retreat. I'm Peter Switzer, and he's not Paul Rickard, but I'm still mad about money. Yes, and Rickard is missing in action, but gee, my colleague Andre Chan really did a great job there. Let's go on to the stories. Larry Fink, now he's the chair and CEO of BlackRock, the biggest fund manager in the world. And Larry reckons that a lot of public companies are currently being forced socially to become climate change supporters. I'm playing a bit of an odd game. Well, and probably he calls it basically an unfair game. A lot of the oil companies are selling their assets to private companies to avoid being punished on the stock market. Now, he reckons that this little trick of private companies buying public energy companies will actually defeat the whole idea of big corporations actually helping to improve the outcome for the climate. So a very, very interesting big call, remembering that BlackRock is probably the biggest buyer of shares in the world. And when they say we're not buying companies that are bad for the environment, that's bad for share prices. But it's interesting that big corporations, some big corporations, are selling their energy assets to private companies who figure they can't be punished because they don't have share prices. I guess there will be some kind of backlash in the future, but in the short term, it's a very tricky play, and the Fink has actually named a few names. Let's go to the next big story, and that is all about the fact that the Reserve Bank has actually basically backed away from its claim that it's going to raise interest rates in 2024. In fact, yesterday, it basically just backed away from its promise to raise interest rates in 2024. And that's because the economy is doing so damn well. It actually coincides with the weekly ANZ Roy Morgan Consumer Confidence number hitting a 16-week high. And that, of course, is linked to the fact that lockdown is over, restrictions are ending, and that's exactly what we saw happening with the new Premier of New South Wales, Dominic Perrottet. He's basically has brought forward all the end of restrictions from December 1 to next week, and that's New South Wales. What's going to happen to the rest of the country? Undoubtedly, Victoria will follow suit, which will be once again great for consumer confidence. Then the big pressure is going to be applied to states like Queensland and WA to see when they are going to start opening up the country. Because the interesting thing is, as we approach normalcy, as we get more and more freedom, the economy is going to really boom. It sets us up for 2022 as a big boom year. That's going to be great for stock prices. It's going to be great for superannuation returns. It's going to be great for job creation. It's going to be great for wage rises. All of this comes together in what you'd have to say was going to be a boom year for 2022, and that will definitely roll into 2023. I'm going to talk about interest rates in just a second, but the bottom line is these boom times have effectively put the pressure on the Reserve Bank to back away from its promise, inverted commas, that interest rates wouldn't rise until 2024. Let's focus on what's going to happen in interest rates. And when Dr. Shane Oliver of AMP Capital saw what the Reserve Bank said yesterday, he started making some sort of predictions around interest rate rises, and he thinks the first interest rate rise now will be a 0.25%, or a taking up of the cash rate from 0.1 to 0.25% in November next year. Then December, another 0.25%. So effectively, by the end of 2022, the cash rate will be at 0.5%. This will undoubtedly push variable rates up. Variable rates will certainly follow what the Reserve Bank does. By the way, the banks could even move beforehand. That's something I've talked about in many of the stories I've been writing recently, that there could be out of cycle bank interest rate increases. But if they don't, They'll certainly start moving when the Reserve Bank does, and you probably will see fixed rates rising for the rest of this year because the bond market is actually raising interest rates already. So all up, we're looking at a 2022 year of strong economic growth, but it is going to be the driver of interest rates. It then will roll into 2023. We will see more interest rate rises in 2023 because of my argument that we're going to be a boom time. And that's when house prices will really feel it. Chris Joy of Coolabah Capital, who also writes for the AFR, Chris made a prediction last weekend that house prices will fall around 20%. Now, they won't fall in 2023 by 20%, but as those interest rate rises start stacking up on those people who've over-borrowed, we will start seeing house prices fall. Not all suburbs will fall by 20%. Some will fall by less. Some will fall by more. A 20% number like that is an average, meaning that some will fall by more, some will fall by less, which means if you are a person who's desperate to buy a home, maybe you should think about, is it really maybe in your economic interest to wait rather than going in too early and paying a silly price now? I'm Peter Switzer, and he wasn't Paul Rickard, and we're mad about money.